Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger and Associates Financial Planning. I'm joined here today again with Nick DeVito, also a certified financial planner, one of my team leaders and lead advisors at my firm, and also a equity owner of the firm. So thank you again for joining me.
Thanks for having me.
So we are on part 2 of a case study, and just a real quick rundown of the case study. We have a 58-year-old widow who does have one child, although unfortunately estranged, through a combination of savings with her late husband and inheritance, et cetera, et cetera. She's basically got about $2 million in IRA assets, $1 million in non-qualified assets, or in investments, shall I say, with a very low cost basis, meaning a lot of embedded gains, about a couple $100,000 in savings type of assets, about $1.5 million in real estate between a shore property and primary residence, and a $300,000 mortgage. So a lot of things that we talked about that were issues were, which we were able to talk about in the first episode, was we talked about the financial planning aspect of it, which really we spent the second segment of the first episode talking about the thought process going into the financial plan, which basically includes, do I have enough money to be able to live comfortably? We talked about cost of living, et cetera, et cetera. We kind of went off on tangents, but it's still good to know. And I will tell you the results of that basically demonstrated no problem. Okay. You could retire tomorrow if you want to. Great. Okay. So now let's take a look under the hood, and let's talk about some other issues, topics, so to speak. And we talked about the one briefly, is the utilization and maximization of Social Security. Social Security, it's been around since 1935. It's when it was introduced, and it has nuances that are most notable when you have a spouse, and more notably, if you are the surviving spouse of someone who passed away. So, starting with, let's say, a single individual. A single individual is allowed to begin collecting Social Security at age 62. And if they were born 1960 or later, then 60? Yeah, 1960 or later, their full retirement age is age 67. So if one takes it at age 62, what ends up happening is that they have a 30% reduction in their Social Security. But what we've demonstrated before is, take, for instance, somebody who has a $3,000 full retirement age Social Security, a 30% reduction means they begin to collect it at age 62. You want to do the math? I can tell you this. First, people say, well, I don't want to do that. It's only $2,100. Well, guess what? You're getting $2,100 for 5 years. Okay, that's $126,000 that you're getting. Okay, oh, okay, in that case. And then if you think about it, now they're short by $900 a month, or they're making $900 more. Turns out that the break-even age is just shy of age 79. However, what about if we were to take into consideration investing that $2,100 that you began to take at age 62? Well, most people would say, well, dude, I'm not investing it. I need it to live on. Great, fully understandable. But what does that mean? Does that mean you're not pulling $2,100 from your investments because now you have this? I mean, if your cost of living is $5,000, you'd be pulling $5,000 from your investments. Now you only have to pull $2,900, which means effectively that $2,100 that's in your investments is invested. And what we demonstrated is that if you earned 5% on your investments, now all of a sudden your break-even age is age 91. If you earned 7% on your investments, your break-even age is age 110. Hence, for that reason, we have a tendency, again, all things being equal, which
They never are.
they never are, but we encourage people to take it early. But one of the things to take into consideration as well is if you begin to collect Social Security prior to your full retirement age, you're restricted as to how much money you can earn. Earn, keyword, earn. You can receive money from your investments, pensions, pulling money from your retirement plans. The litmus test is income that is taxed by Social Security, which is earned income.
Yeah, that about $2,000 a month, round numbers,
Right.
is the limit currently in 2026. And to Mike's point, typically when we're looking at Social Security, if you're looking at one person and it just their Social Security benefit, not factoring in a survivor, typically we will suggest that they begin collecting at age 62, unless they're working and whatnot. Because if you're working and you go over that roughly $2,000 a month limit on Social Security or on earnings, for the purpose of back testing your Social Security, it's actually going to reduce your Social Security by $1 for every $2 that you go above that $2,000 a month. So doesn't make sense if you're collecting and still working and making more than that. But really where the nuance comes in and what we're going to be diving into today in this case study is going to be, what about if there's a survivor benefit factored in there? Because that really does change the complexity of the situation and will dictate a different route that we'll be taking.
So to put it into perspective now, going back to the whole Social Security, if your full retirement age is age 67, what happens is that if you delay it, your Social Security goes up by 8% per year until age 70, at which point it caps out. It never goes any higher. So the age 62, anywhere from age 62 to 70, from an actuarial perspective, as calculated by the Social Security Administration without taking into consideration growth rates, which we like to take into consideration, from an actuarial perspective, taking it at any time is the same thing. All right. So what happens with a survivor? Okay. What happens with a survivor is at age 60, they can actually get 71.5% of what their late spouse either qualified for or what their actual payment was. In this particular instance, her late husband was long before his full retirement age.
Or even before Social Security age where he wasn't collecting.
That's what I mean by that. So what would happen is she would go off of what his full retirement age value would have been. So let's say his full retirement age, let's say it was only $2,000 a month. Well, the fact of the matter is she would be able to get 71.5.
Yeah.
Who came up with these numbers? Probably the same knucklehead who came up with age 59.5 for collecting, without penalty, and age 70.5 for
QCDs, RMDs.
It's not
alphabet soup.
Right. It's not even as if we're converting from metric to English.
That's true.
I don't understand. But anyway, be that as it may. So they got 71.5%. So even if her late husband would have had a full retirement age of 2,000, what this basically does is it gives her $1,430 at age 60. So what she could do is begin to collect that and then let her Social Security grow. And if her full retirement age Social Security was $3,000, then 24% of that is $720. She would be getting $3,720. Now let's go back to the first statement I made. Whether she's age 62, 67, 70, or anywhere in between for her own Social Security, actuarially, it's the same number. But if we can kick it out to age 70 and collect the survivorship for 10 years, way ahead. I don't even know what the break-even age would be. Age 350?
Yeah, something like that, right?
It's absolutely crazy to know what that would be. So, but once again, those same restrictions apply. If she were to begin collecting Social Security, the survivorship Social Security at age 60, the same early rules apply. Collecting it before age 67, even though it's not your own, if you're collecting the survivorship, you're still restricted to earning $24,000 a year or $2,000 a month, roughly 24. It goes up with inflation every year. We just like to say $2,000 a month. So that factors into the whole retirement plan. When we ran the retirement income models, we ran that and we're like, holy cow, I mean, you made it flying colors all by yourself. You want to throw an extra $1,400 a month in there?
Yeah, makes it even, the colors are flying higher.
That's correct. That's correct. So we wanted to talk about the Social Security nuances because of the fact that they exist. And, being able to take advantage of the survivor Social Security, and we've have a lot of clients who are taking advantage of the survivorship Social Security. In fact, ironically, we were referred to a client by a accountant, and this client had reached full retirement age at age 67, and she asked the accountant, "Hey, should I begin collecting Social Security now?" And he said, "I don't know. Why don't you call Mike?" So fine, she calls me, and I was chatting with her a little bit, and I said, "Were you married?" "Yeah, I was." And "Is he still alive?" And she goes, "No." I'm like, ding, 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 ding.
Yeah.
Boom. She turned on the survivorship. She was over age 67, so she was allowed to begin collecting. Actually, her full retirement age was earlier than that. And she's collecting, and then at age 70, which she just reached, we flipped it over to hers. But we do this all the time, and it is remarkable how many people don't know that.
Yeah, and honestly, that's the benefit that you have working with an advisor is our job is to know all those little nuances associated with Social Security. It's not like they are broadcasting all this information, just putting it out there. You have to kind of go looking for it to figure it out. So that's, being informed, being educated, and understanding how the system works is key when coming up with a plan for yourself.
Absolutely. And that's with everything, not just Social Security. So, all right, we'll talk about that. Now let's talk about the possible, that's going to take us too long. So let's talk about the long-term capital gains that we've got. Okay. That $1 million account, number one, we looked at it. It's 100% stock. And we got $800,000 in capital gains. And we're scratching our head. And not only is it 100% stock, but about 300,000 of that is in leveraged. In other words, I don't know, are they considered leveraged?
Yeah, they're leveraged ETFs.
Right. So in other words, they're basically, if the NASDAQ goes up 5%, this goes up 10%. But if the NASDAQ goes down 5%, this goes down 10%. And the other one's 3 times the S&P. The S&P goes up 5%. This investment goes up 15, but if it goes down 5, it goes down 15. And I know in previous broker dealers that we've worked with is they disallow buying these investments. In fact, I actually had one that transferred in, and we were told by the broker dealer, we have to sell it because they don't want it in the accounts because they're considered extremely high risk. And their explanation to me, which I didn't really completely buy, but they said this should be for day traders and not a long-term hold. Which I didn't completely buy that argument, but when I was told to do something, you kind of have to do that. And I thought it, and I'm like, I'm not going to just sell it for the arbitrary selling it. What we did is we put stop limits in, said if it did drop, but
unloading it, yeah.
But it followed us up. So we were able to do that. But anyway, so we were taking a look at those long-term capital gains. I'll tell you what, we're at a good breaking point. Let's pick up on that at the end of in our next segment. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. We are now continuing on, and we wanted to spend some time talking about the unrealized capital gains. It's an issue, all right? Well, it's an issue because of a couple things. Number one is if you have $1 million account that has $800,000 in capital gains, that means at one point you started with $200,000.
Good problem to have.
A good problem to have, but taxes come with it. All right.
Yeah, especially and really the crux of the issue we are looking to begin using this account for distributions. If she were to retire, funding those retirement needs, if we're doing Roth conversions or paying tax bills, which we're going to talk a little bit more about later, but this is going to be the account that we go to. And anytime you're doing any level of investment planning, what we will suggest that people start with is figuring out what you're going to be needing from that account in the next couple years. 2 years typically is what we like to do. So any funds that you know you're going to be drawing from any account, whether it's a brokerage account, whether it's an IRA, Roth IRA, bank, whatever account it is, any funds that you're going to be pulling from in those 2 years, you want to make sure they're in something that is extremely conservative, something that is not going to be going up and down with the markets. And I'm not even just saying the stock market, that could be the bond market as well. So when we're talking to clients about that, we typically will recommend that they put those ultra conservative investments in something like a money market fund or an ultra short-term bond fund, so that if you need $10,000 at the end of this year, the $10,000 that you have set aside is going to be worth $10,000 at the end of the year, and it's not going to be worth $7,500, $8,000, whatever else could happen. You just want to make sure you're taken care of from that standpoint. And then you also, after you make sure that 0 to 2 year time frame is satisfied, you want to take a look at the 2 to 5 year time frame. And you're going to want to adjust that bucket as well, so that it's in a more conservative type investment, like a bond fund or bond holdings, whatever it works best for you. Because once again, the last thing you want to have to be doing is selling an investment when it's down. And by taking this approach to it, you're going to avoid that. 2022 was a great example.
I just brought it up.
And honestly, one thing we always talk about with clients is when we're drawing this on the board for the clients, we're saying, okay, 0 to 2 years, ultra conservative. 2 to 5, conservative. 5+, that's much more of your individual tolerance for risk. And that can be more of your stock, mutual funds, ETFs, whatever works best for you. But 2022 illustrated this perfectly, because in 2022, the stock market was down 19% and the aggregate bond index was down about 13%. So if you are a traditional portfolio of just stocks and bonds, you were likely down somewhere between 13 and 19%. There was nowhere to hide. However, if you would have had that ultra conservative bucket built into your portfolio, whether that was money market and ultra short-term bond fund, that did not go down in 2022. So you were not forced to sell any investments while it was down. Now, this was because of extraneous situations, but one of the better performing asset classes that year was the money market, was the ultra short-term bond funds, because in 2022, inflation was running rampant. The Fed was hiking interest rates honestly exponentially, went from basically 0 to over 5 in a hurry. And so that pushed the yield up on all of your money market, ultra short-term bond funds. So they actually did really well in 2022, but really just illustrated the point of why you need to have that bucket carved out. And then what you have the ability to do is, okay, well, in 2023, 2024, and 2025, when everything rebounded, you could backfill. You could push money back into that bucket.
And to be clear, not everything rebounded. Okay, what happened is, coming out of 22, stocks rebounded, okay? But it took them probably 6 to 8 months in 23, of which, let's be clear, in 23, it was only 7 stocks that vaulted the market. Because in 23, if you were to go January 1st to October 31st, the S&P 500 was up 13%. 7 stocks were up 66%. The other 493 were flat. So the reality of it is that only a few stocks really drove the market. In fact, I'll go one step further, because we track this, is bonds did not recover their losses until more than 3 years later. Okay, now, rule of thumb, typically stocks and bonds do, stocks do well, bonds aren't doing as well, bonds are doing well, stocks aren't doing as well. That's one of those extraneous stimuli that hit both of them. Examples could be 2008, the massive recession that we had then, or COVID. Well, 2022 was another example where both of them were down at the same time, which doesn't happen often, but it does, which further illustrated that if you're drawing money off your assets, to his point, you never want to be forced to sell an investment when it's down. understandably, you may sell investments when they're down because they're going to go down more. You're trying to take capital losses or anything else, but you don't want to be forced because you need the money. So that's our first thing we're looking at. And now we're looking at this account and saying, okay, not only do we want to be able to carve out safer assets, but my goodness, we got an extremely aggressive portfolio. It's a lot of individual stocks, which, again, I like stocks, but anything can happen to an individual stock independent of the stock market. Okay. And the example I use, I remember during Sarbanes-Oxley, which is like 2022, the government came to IBM and said, hey, the IRS said, hey, we think you're doing some of these accounting shenanigans. IBM dropped 20% in 2 days. All of a sudden, 3 days later, the IRS comes back and says, oh, I'm sorry, guys. We were wrong. You guys, you guys were okay. Well, guess what? It didn't come back. But IBM, all independent of the market, lost 20% in a couple of days. So, that's the example. I'm not using that example. Things can happen to an individual company. Enron, that was a house of cards, but it lost all of its value. It was actually the 6th highest ranked company on the S&P 500, and it lost all of its value and went bankrupt in a very short period of time.
Yeah, there's just a lot more risk associated with holding an individual stock as opposed to an ETF or a mutual fund, because you're diversifying your risk. And I mean, the way to think about it is, let's say you have a technology ETF, for example, and it has Tesla and Apple and Microsoft and Google in it, and Google goes down 40%. But everything else is up. It helps offset some of those losses. So while you certainly can get into the individual holdings, maintaining a diversified portfolio is much more safe for you as opposed to individual holdings.
Right. It's just less risky associated with just diversification. Okay. And so we take a look at this portfolio, and it's predominantly about 7 or 8 stocks and the leveraged ETFs, which are 2 or 3 times the NASDAQ and the S&P, and we're looking at it and we see the one that's 2 times the NASDAQ's worth $200,000 with $180,000 in capital gains. If we're trying to de-risk the portfolio, that's probably the first place you go. Okay. In fact, that fund was down 10% last Friday, one day. Okay, that's, by the way, not good.
No. Well, what was good is we got out of some of it before that.
That is correct. All right, be that as it may. So now, what else happens? All right, so now that we are selling, we're thinking capital gains. Now let's talk about that. So she's single, 80 grand. Capital gains are going to get taxed at 15%. Fine. Okay, our take is that they're going to be taxed at 15% today. 5 years, 10 years, 20 years down the road, they're going to get taxed at 15%. The only way they don't get taxed at 15% is if you die, which we're not doing that as far as our financial plan.
Yeah.
Okay. I mean, the whole idea is for you to be alive.
And using them. More importantly, she needs to use the money.
Exactly. So that's one way. Or the stock drops like a stone and it loses its gain. Neither one of those 2 scenarios are desired. So we're looking through and saying, hey, we need to reduce gains. Now, so you figure she makes 80 grand. Going to pay 15% tax on it. Talking Fed only. We're paying tax at the state level. Doesn't matter what your income is. It's a flat tax of 3%, 3.07.
In Pennsylvania.
In Pennsylvania, correct. So now we're looking at it from the federal level. So once you break through $200,000 for single, $250,000 for married, you have what's called NIT, which is net investment income tax. And that's an extra 3.8%.
Now that 3.8% is going to apply to any unearned income. And what I mean by that is interest, dividends, capital gains.
Correct. Okay. So now we're exposing ourselves to that. Then once she gets above it, I don't know exactly what the number is, but it's in the vicinity of 550,000. Those capital gains are taxed at 20%. That's a lot of room that we have. Okay. But what we're really looking at is the next threshold is 500,000. Okay. With the Trump tax law changes that occurred in 2026, basically what they did is 25, it was last year. So what they did is they instituted or reinstituted SALT. That's not table salt.
Man.
State and local taxes. Okay. So what happened was historically your Schedule A, which is your itemized deductions, capped your ability to take state and local income taxes, capped it at $10,000. In this particular instance, we've got a shore property and a primary residence, and between the two, the taxes are over 15 grand. Okay. Now that opens the door to being able to take those taxes plus any Pennsylvania tax that we're paying on gains, plus any state tax that she's paying or local tax that she's paying on her income. Guess what? We keep it under $500,000 and suddenly
she can use all that. Yeah. So the way it works is with the itemized deductions, specifically the SALT, if your income is above a certain threshold, I think it's $500,000 or $505,000, somewhere around there in adjusted gross and modified adjusted gross income, you actually begin to lose the ability to deduct some of the SALT. And if you're above that, if you go high enough over that, you're going to be knocked back down to, instead of having a $40,000 SALT limit, you have a $10,000 SALT limit. So it's something that you really need to keep in mind from a tax planning perspective, because you could be losing deductions if you're going over those thresholds. And these are all the things we're looking at. We really look at everything when we're doing tax planning. We're factoring in NIT. We're factoring in the SALT deduction. We're looking at your regular tax rates. Where are you for capital gains, the 15, the 20? Are you in that 18.8 with NIT there as well? So we really try to look at everything when we're doing the tax planning.
Correct. And there's just so many different nuances that we throw out there to take into consideration, to your point. So we're at a good breaking point here. We're going to finish this episode. What we're going to do in part 3 is then we're going to talk about the Roth IRA conversion, or the runaway train, so to speak. And then in the final part, now we're going to tackle it and say, how do we pull all these things together with a strategy moving forward? So thank you for joining us today. Thank you again, Nick, for joining me. And we'll be back with you on the next episode of Financial Planning Explained. You have a wonderful day and week.